Hi, my name is Robert, and I work on the investment team at the Draper Dragon Fund. We're an early stage venture capital firm under Tim Draper's family of funds. I focus primarily on the crypto and fintech verticals at Draper Dragon, and our team has been allocating capital towards crypto-related venture investments for about 3 or 4 years now. This is a space that is truly fascinating, and I'd love to share with you today some interesting developments that we see. My topic today is specifically about institutional investment in Bitcoin. And as you may know, investors in Bitcoin have been and continue to mostly be retail investors who are trading for their own account. And this contrasts very sharply with some of the other asset classes that you see, like equities, like fixed income, like FX, like commodities, where institutional investors have a strong, sometimes dominating presence. Um, I think this is starting to change for Bitcoin, right? Many people in the crypto industry, myself included, have been very excited about the prospect that mainstream institutional investors are going to get into crypto someday. And I think that in the last 2 years, especially this year, we're seeing some strong signals that this is starting to happen. And let me give you a few examples of what I mean. So earlier this year, in I think May, Paul Tudor Jones, who is a well-known global macro fund manager and the founder of Tudor Investment Corporation, he publicly praised Bitcoin as a hedge against inflation. And under his management is the Tudor's BVI Global Fund, which has been authorized to hold a low single-digit percentage exposure to Bitcoin futures, according to a note that it sent to its investors. And there's even a news clipping of Tudor Jones on CNBC talking about his views on Bitcoin. Just happened is that Guggenheim, they have their $5.3 billion macro opportunity fund just disclosed in a regulatory filing that it reserved the right to invest up to 10% of its NAV in Bitcoin through Grayscale's Bitcoin Trust. And something super interesting that we didn't really expect happen, but it did. MicroStrategy and Square became the first two publicly traded companies here in the US to hold a part of their corporate treasury in Bitcoin. I think MicroStrategy bought something like $250 million worth of Bitcoin a couple months ago, and Square bought something like 50 mil, I believe. Some would also say, you look at the CME Bitcoin contracts as a barometer of institutional involvement. And to that point, CME's Bitcoin futures product saw a big surge in activity in 2020. And open interest right now currently stands at about 8 times what it was 12 months ago. Somewhat related to this is you read some of these sell-side analyst reports written by folks at JP Morgan, Citibank, and BlackRock, and many of them have made bullish price predictions as well as compared Bitcoin to digital gold. Right? And, these are reports that are read by investors worldwide and very well respected in traditional finance. And so, before we dive any further about the subject matter, I think we should address the question of who institutional investors really are. And I think when people talk about institutional investors, they're really referring to a broad classification that encompasses pension funds, mutual funds, sovereign wealth funds, hedge funds, private equity and venture capital funds. Some would even consider folks like proprietary trading firms, as well as the investment managers who are representing high net worth individuals, family offices, and corporate treasuries to be part of that mix of institutional investors. And so what you might notice is that when based on this definition, institutional investors are not really a monolith. In fact, it's pretty tough to generalize about institutional investors as a whole, given that there's so many different types. Let me give you a few key distinctions, though, between institutional investors and retail investors. And I think first and foremost, institutional investors simply mobilize larger amounts of capital when they choose to deploy on towards a certain asset class, a certain asset, towards a certain strategy, right? They're subject to different kinds of regulatory requirements. These investors vary amongst themselves and differ from retail investors by things like different investment objectives. They have different risk tolerances and different investment horizons. And many of these institutional investors are investing on behalf of their clients. And so in that sense, they're actually acting on a fiduciary capacity, not acting on behalf of themselves. And so, given these differences, there's actually very important implications on how institutional investors make decisions, what strategies they choose to adopt, and the workflow that they take when executing those strategies. And there's a few major themes to be found amongst the reasons of why institutional investors find Bitcoin interesting and why they've all come out in 2020 to speak about and declare their support for Bitcoin, right? First and foremost, one thing it is not is, I would say, institutional investors are generally not interested in Bitcoin as cash. Satoshi Nakamoto's intentions for Bitcoin to be a peer-to-peer electronic cash never really materialized. I would say that some institutional investors, they treat Bitcoin as a durable store of value. And this is largely because Bitcoin has a fixed supply schedule. The currencies of countries like Venezuela, Argentina, Zimbabwe have had big inflation problems in the past, and these problems are still ongoing. And as a result, you have the individuals who have a large exposure to these currencies, and institutions that have a large exposure to these currencies, seeking a better store of value. And for those, Bitcoin is suitable even despite its high volatility and limited utility as actual currency. And I think in context of 2020, you've seen the pandemic taking a very big toll on economies all around the world. And the governments, the central banks of these countries have taken to mobilizing fiscal and monetary policy to an extent far extending beyond the measures undertaken back in 08-09 financial crisis, right? And so to give you some idea of what that means, more than 90 countries have used some form of monetary policy measure. And in the US alone, they launched this new wave of quantitative easing, and that's resulted in a federal balance sheet that now stands at over $7 trillion in assets, right? M2 money supply in the US has been growing 24% year on year since July. And this is comparable to the 5.9% average that we've had since 1982, right? So it's far exceeding the growth, average growth that we've seen over the last 40 years. And this has stoked some new fears amongst both retail investors as well as institutional investors about oncoming inflation, because money supply and inflation are linked. And so institutionals are sometimes treating Bitcoin as a hedge against fiat currency. Now, there are some other institutional investors who are attracted to Bitcoin's superior risk-adjusted returns, which are pretty attractive over a multi-year horizon. And to come to that conclusion, you can just look at the Bitcoin's returns over the last 5-10 years, right? And over the last 4 years, I can say that Bitcoin's Sharpe ratio has been 2.7. And you can compare this with other asset classes like U.S. equities, for example, has a Sharpe of 1.5 over the same time period. I think U.S. bonds probably less than 1. This year especially, Bitcoin's returns have been pretty phenomenal, and it's up 150% year to date, vastly outperforming basically every other asset class out there. And that has certainly drawn some attention, right? Investors really like Bitcoin's low return correlation with other assets like equities, fixed income, commodities. And so in that sense, it has a pretty good diversification benefit for money managers who maybe have exposure to a broad basket of different assets. Now, some are here to profit from arbitrage opportunities in the Bitcoin market. Some institutionals are here to make markets for Bitcoin and other Bitcoin related products. And so these folks, they may not take a very long Bitcoin view, but they're here to exploit some of these pricing inefficiencies, and also here to make money by capturing the bid-ask spread, right, when they make markets. Some institutionals participate mainly by providing certain kinds of services to Bitcoin investors without necessarily being Bitcoin investors for themselves, right? An example would be Fidelity Digital Assets, which is a subsidiary under Fidelity Investments. And they're providing custody services, execution services, other stuff as well. And so institutional investors can get exposure to Bitcoin returns in quite a number of different ways. They can invest nakedly in Bitcoin on the spot market. They can invest in Bitcoin derivatives. They can invest in entities like index funds and exchange traded products. And they can assign active fund managers to trade Bitcoin. Lastly, I should mention that some institutional investors are actually more excited about blockchain technology and distributed ledger technology than Bitcoin, right? To give you some examples of what I mean by that, 2 years ago, Yale Endowment Fund and Fairfax County Pension Funds invested in, I think, a couple different crypto VC funds, right? And these crypto VC funds, much like ourselves, primarily invest in companies that are using blockchain technology in other kinds of use cases in varying ways. And Harvard Endowment Fund had directly invested in a crypto company's token offering, right? Another way that some institutional investors are, more excited about blockchain technology, they may be using, this underlying technology in improving the settlement and clearing of traditional assets, whether they're equities, whether they're ETFs, whether they're bonds. Now, I think there are a few issues that are still holding back the majority of institutional investors from allocating capital freely towards Bitcoin. And I'd like to name some of those today. Number one would be reputational issues, right? So stemming from Bitcoin's previous association with organized crime and terrorists and online drug dealers, I think in years past, many folks were very quick to casually dismiss Bitcoin as a fraud or as a scam. Now, I think a lot has changed in the recent years. Government agencies have been working very closely with companies like Chainalysis to identify malicious activity like money laundering. And Bitcoin's reputation, I think, will start to change for the better, especially as these thought leaders, like I mentioned, Paul Tudor Jones or Steve Druckenmiller from traditional financial services start to publicly endorse Bitcoin. Now, there's another big one, which is regulation. And granted, this varies very much so between different jurisdictions. Some countries are much more forward-thinking when it comes to cryptocurrency than others, which are less advanced, maybe less educated, right? I think when we talk about the U.S., in many ways, crypto regulation here in the U.S. is not mature. And spot exchanges in the U.S., spot crypto exchanges in the U.S. are not regulated in the same way that national securities exchanges like NYSE or NASDAQ are. And so, as you can imagine, they're not held to the same kinds of standards of investor protection. So crypto broker-dealers, similarly, right? And, they're not regulated in the same sense that securities broker-dealers are. And there's a few light spots where you can see, CFTC has deemed Bitcoin to be a commodity, and venues that offer Bitcoin futures like CME and BAC operating in the US have to operate under CFTC oversight. And as a result, I think, generally institutional investors feel more comfortable participating in a market that lives under a regulatory framework that they're familiar with and that is well policed, well enforced. Another thing I should point out is that earlier this year, again, you have the OCC publishing a letter where it gave official permission to US national banks to provide custody services, as well as to provide banking services to custody companies. And this is a huge step forward. Granted, we're waiting for more specific regulation and guidelines for how these banks, and as well as non-bank financial institutions, should go about to deliver these services. But this is a big breakthrough, right? And I think many banks have since expressed their due interest in developing, their in-house crypto services, which is gives me a lot of hope for where we're going in this country. I remain very hopeful also that the many regulatory bodies here in the U.S. will eventually deliver, thoughtful rules and guidelines for crypto companies to follow. And they are paying attention to the issue and spending a lot of time discussing it internally, as well as in collaboration with the various folks who are delivering crypto services today. One other aspect would be the fear of market manipulation. And I think, they're not wrong to think that. This is not an unreasonable fear, given that historically there's been a great deal of Bitcoin market activity occurring on certain overseas exchanges where they exist and operate under little regulatory oversight. And as a result, these exchanges get away with poor market surveillance practices, poor KYC AML practices, negligent customer due diligence practices. And when exchange operators do not prioritize investor protection, that leaves room for market abuse and market failures. Investors who trade on those exchanges risk being exploited by bad actors. Volatility is something that concerns certain institutional investors. I think I read somewhere that earlier this year, so far this year, Bitcoin's monthly price change has averaged about 10%, maybe more than that. Some of them have pointed out that, this is worsened by highly levered positions on offshore exchanges, given that leverage is very easily accessible at these places. And you might find that in the Bitcoin market, flash crashes still occur somewhat frequently. And the last point that's holding certain institutional investors back may be, until recent years, this broad lack of institutional services and tool sets. And, this goes to the point that the kind of pain points that institutional investors experience when they trade, when they try to secure and manage their crypto assets, are quite different from those of the average Joe retail investor. And some of these pain points are still not very well met today. I want to list a few of these pain points. Right? So, institutional investors, they tend to be more sensitive to transaction cost than retail investors. And that's because they trade in size. They want to minimize price slippage when they trade. And sourcing these block size liquidity in Bitcoin's fragmented market is it's a technological challenge. They care a lot about security more than the average Joe retail investor. Stakes are pretty high when institutions hold a lot of Bitcoin. And so they need some way to keep their coins safe. Lastly, you may see that a lot of these institutional investors, when they try to participate in the Bitcoin market, they brush up against the treasury management problems when they trade Bitcoin across a number of different market venues. And that's largely because of the requirement to pre-fund their trades and settle trades individually on each venue independently, right? And this creates a huge operational headache. It also means that institutional investors cannot deploy capital very flexibly. And so, this is a good segue into what we do here at Draper Dragon Fund. Over the last 2 years at our fund, we've been casting bets on startup companies that cater to these pain points that I spoke about. These types of startup companies provide services that form the financial market infrastructure for crypto and stand to really benefit from crypto coming to mainstream finance, because they facilitate the kind of way that institutions prefer to trade and manage their Bitcoin holdings. Now, very interestingly, I would point out that the founders behind some of these sort of companies come from senior positions on Wall Street, where they previously built similar things for mature asset classes like equities or FX. We care about subsectors like Bitcoin exchanges, Bitcoin derivative exchanges, custodians, broker dealers and execution services, market data vendors, lenders, settlement solution providers. And this is probably a good time for me to highlight a few investments we made in the previous years, right? So we invested in Ledger 2 years ago. They're a crypto custody technology company. And a lot of people don't know that they have this business unit under them called Ledger Vault, which is dedicated to serving institutional custody needs. And Ledger Vault is well positioned as a vendor to banks that want to service crypto, but may not have the technological competency to custody client assets. And this year, Ledger actually collaborated with the Nomura Bank to launch a joint venture called Komainu, which is a digital asset custodian for institutional market participants. We also invested in Shield Market earlier this year. They're a crypto broker and dark pool based in France. And ever since they received their digital asset service provider license from the French AMF, which is equivalent to the SEC here in the US, they've actually been approached by a lot of family offices and wealth managers in Europe who have taken an interest in Bitcoin. There's Hong Kong Bit Exchange, which is a professional crypto exchange based in Hong Kong, and it's regulated under the Hong Kong's Securities Exchange Reg framework. They want to cater to Asia-based financial institutions that want to trade Bitcoin. And so, moving forward, we expect these types of companies to play a major role in ushering institutional market participants into the Bitcoin world and capture value from doing so. So it's very much of a picks and shovels play. And in a few years, I expect there'll be a much more diverse investor base behind Bitcoin than we see today. So for those who are listening, if you believe that, as I do, institutional Bitcoin investors like Tudor Investment Corp or Guggenheim are just the tip of a very large iceberg, then Bitcoin is probably still cheap to buy now, even though we are at nearly all-time highs in Bitcoin price. And in conclusion, I imagine that at some point in the future, Bitcoin can become much less exotic of an asset and much more mainstream. You'll find Bitcoin in the portfolios of corporations, in the portfolios of government treasuries, in people's 401ks and pension plans. And thank you for listening.